In today's video, I'm going to share 5 ways to use rental real estate to avoid W-2 taxes. Now, I decided to make this video because there is just too much misinformation out there from tax advisors. Advisors saying that real estate tax savings is only for the super wealthy, or how you can't save on taxes for using real estate because you make too much money, or that real estate doesn't save you taxes because you don't own enough rental properties, or maybe you've heard that you can't save on taxes unless you have legal entities for your rentals. Here's the thing, none of those are true, and I'm going to share 5 ways that you can use real estate to avoid W-2 taxes. In fact, I'm not just talking about W-2 taxes. You can actually use real estate to avoid taxes from all different types of income, including other real estate, businesses you might own, income from your crypto, stock sales, or even retirement income. All of these strategies can be accomplished with even just one rental property. Yes, even one rental. It does need to be the right rental though. All right, let's go ahead and get started. The first way to use real estate to offset W-2 income is using the $25,000 rental allowance. What this means is that if you are someone who makes $100,000 or less and you invest in rental real estate, you can actually use up to $25,000 of rental losses to offset taxes from your W-2 income. So this works really well for those of you who are investing in long-term rentals, in midterm rentals, all types of real estate investments. And if you make $100,000 or less, there's no additional things that you need to do. You can generally use up to $25,000 of rental losses that you create to offset taxes from your W-2. Keep in mind, in this video, I'm talking about tax losses. And by that, I don't mean losing money on your rental properties. I mean strategically created tax losses. So how do we create tax losses? Well, from things like maximizing our tax deduction, writing off your mortgage interest, property taxes, repair costs, and other things like business travel, business use of your car, or even a home office. And last but not least, as real estate investors, we all get to take advantage of the wonderful benefit of depreciation. Depreciation is really amazing because we can use depreciation tax benefit regardless of whether the property value is actually appreciating or going down in value. And so for most real estate investors, what we try to achieve is positive cash flow, appreciation in real life, but when it comes to taxes, creating a tax loss. Now you might be thinking, what happens if I make over $100,000? Well, if you're someone who makes over $100,000, if your income level is between $100,000 and $150,000, then you can use part of this $25,000 rental allowance. There's a phase out of about 50 cents per dollar when you're within that income limit of $100,000 and $150,000. So what that means is if your income is above $150,000, then we have to look at other ways to use real estate to offset taxes from your W-2 income. The second way to use rental real estate to offset taxes from your W-2 income is for those of you who have income over $150,000, and that is using the real estate professional status. Now, real estate professional status is probably one of the more common mistakes that I see made by CPAs all the time, and so let's make sure we take a deep dive into exactly what that is. So like I said, if you invest in rental real estate and your income is over $150,000, you can no longer use that $25,000 loss allowance. However, if you or a spouse is a real estate professional, then you can use your rental losses against W-2 and all other types of income on your tax returns. Let's talk about what is a real estate professional. Real estate professional is a designation that the IRS looks for. It actually has nothing to do with whether you are licensed as a realtor or broker, and they don't really care what licenses you actually hold. So can a part-time teacher be a real estate professional? Absolutely. Can a retired doctor be a real estate professional? Yes. To be a real estate professional, the IRS looks at a set of tasks and hours to see whether you've met those qualifications. There are a couple major things that you want to be able to meet to be a real estate professional, and then use the rental losses against your higher W-2 income. First, to be a real estate professional, you or your spouse have to be able to show that you earn at least 750 hours in your real estate activities. So if you happen to be a realtor or broker, then your hours for your real estate business also count towards real estate professional status. Or if, let's say, you are a stay-at-home spouse, well, then your hours on your rentals could count towards real estate professional status. So minimum of 750 hours in real estate businesses. The second rule that you also have to meet is you have to spend more time in real estate than you do your other jobs or income activities. And so if you are someone who is working full-time in the tech space, then odds are it's going to be difficult for you to become a real estate professional. If you're working 2,000 hours at your job, it's going to be almost impossible for you to spend more than 2,000 hours in real estate activities. Now, here's where this benefit comes in really well if you have the right facts. So let's say that you work full-time as a physician and you have a stay-at-home spouse taking care of kids. Well, your spouse could be the one who tries to earn real estate professional status. Because your spouse doesn't have a full-time job, or maybe is only working part-time, then they don't have to meet that more hours than other income requirement because they don't have other income or other businesses that they're operating. All right, and the third requirement to meet if you want to use your rental losses against your W-2 income is you have to materially participate in your rental real estate. What does that mean? That means as a property owner, you are involved in the day-to-day of the rental properties that you own. So 750 hours in real estate minimum, more time in real estate than your other jobs or businesses, and material participation on your rental properties. Once you or your spouse meets all three of those requirements, then you can use rental losses against your W-2 income. This works really, really well for a lot of our clients where one spouse is a high income earner or operating a really profitable business, but they have a spouse who is not working full time. So there's a really great combination where as long as that spouse meets real estate professional status, then you can strategically create a lot of tax losses and use it to offset taxes on the other spouse's W-2 income or income from their business. When you hear investors talk about how, they made a lot of money as a doctor and they paid very little to no taxes using real estate, odds are either they or their spouse is using the real estate professional status to save taxes. All right, the third way to use rental real estate to offset taxes from your W-2 and other income is what I call the sell and save strategy. This is for those of you, let's say you are not able to meet real estate professional status. Maybe your spouse isn't either. Maybe you're both working full-time at high-income jobs. Guess what? In the years when you were not a real estate professional, all of your losses were considered passive losses, which means that you don't lose them. You just instead get to carry them forward from year to year and use it up as you have additional income from your rentals or other passive sources. Now, in the year that you decide to sell your rental properties, all those accumulated losses gets freed up. So when the property is sold, those losses actually become ordinary losses. And so in the year of the property sale, you actually do get to use it to offset taxes from your W-2 and other income, regardless of whether you're a real estate professional or not. Here's a quick example. Let's say I invested in a property on Main Street. Over the years, I've accumulated a lot of tax losses through write-offs and depreciation and paying my kids and taking a home office. I haven't been able to use it because I was not a real estate professional and my income is too high. Let's say I've accumulated $40,000 of losses over the years. In the year I sell my rental property, all that accumulated loss actually is freed up and I can use it to reduce taxes on my W-2 income this year. This is a tax benefit that not a lot of people understand, not a lot of CPAs talk about it, and it's actually a really important one. Why? Because we always come across investors who say, I'm not really seeing any tax benefits on my rental real estate right now. Maybe I'll just sort of give up or stop tracking my expenses because I don't care as much. This is a really good example of how even if you're someone who is not seeing an immediate tax benefit on your rental real estate, you still want to make sure you capture and maximize all of your deductions, because eventually they will pay off and they will save you taxes on all of your income. All right, the fourth way that we can use rental real estate to offset taxes on our W-2 and other income is in looking at the short-term rental tax loophole. If you invest in short-term rentals like Airbnbs, Verbos, where the average guest stay is 7 days or less, then you can potentially use this loophole. And we call it a loophole because unlike the long-term rentals earlier where I just said you or your spouse might have to be a real estate professional to use the losses, in the short-term rental space, you actually don't have to be a real estate professional at all. In fact, we don't care how many hours you spend working at your job. If you invest in short-term rentals, as long as you meet material participation hours requirements, you can then use your short-term rental losses immediately to offset taxes from your W-2 and other income. So what are material participation hours requirements for short-term rentals? Well, very similar to what we talked about in the long-term rental space. In the short-term rental space, you have to make sure that you are earning hours involved in the day-to-day operations of your short-term rental property. So that could mean getting the property ready, staging it, furnishing it, dealing with the guest turnovers, coordinating with the cleaning crew. So as soon as you meet the material participations hour requirements on your short-term rentals, you can use your real estate losses against your W-2 and other income. This strategy works really well for single individuals who have high W-2 income and don't plan to quit anytime soon, or married individuals where both spouses work full-time and real estate is just a side hustle. This is where we see a lot of clients who both have high-paying jobs buy a short-term rental in the local mountains or by the lake or by the beach and be able to create hundreds of thousands of dollars in tax write-offs and be able to use that against their W-2 income, all the while still working full-time and real estate just being a side hustle for them. Now, the fifth way to use rental real estate to offset taxes from your W-2 income is probably something you have not heard of before, and that is with boutique hotels. Boutique hotels has been something that has been growing in population. We have a handful of clients who've started investing in this space. It's basically a short-term rental, but you're doing it at a more scalable way. Instead of having one door, one short-term rental, you have a portfolio or a property, a multi-unit property that you're operating as a boutique hotel. If you invest in the boutique hotel, you may be able to use rental losses created from that boutique hotel to offset W-2 income, similar to the short-term rental loophole. So if your average guest stay in your boutique hotel is 7 days or less, then it operates just like a short-term rental. So you can use it to offset taxes from your W-2 as soon as you meet material participation hours. And now for some of our clients, they're actually operating those as hotels where they're providing additional services like daily cleaning and food service and helping to curate excursions. And so if your boutique hotel does provide additional hotel type services, then usually that's treated as an active business, similar to a regular hotel. And in that scenario, you actually don't have to be a real estate professional. You can use tax losses from your boutique hotel against W-2 and other income. As long as, again, you meet material participation requirements, meaning you are involved in the day-to-day operations of that specific investment. So there we have it. 5 different ways to use rental real estate to offset taxes from your W-2 and other income. So the next time you hear someone tell you that there is no tax benefit when you invest in rental real estate, you can direct them to this YouTube video and they can learn something from you. If you like this video, be sure to hit the like button and subscribe for more tax savings tips.